Might as well make it 10,001. So before we jump in, I did want to introduce a couple of new faces that we have here with us tonight. So we have an initiation process that we do with the newbies. No, I'm just kidding. But we do like for you to introduce yourself a little bit. Give us just a brief background about yourself, 30, 60 seconds. And then tell us ultimately what it is that you're wanting to achieve, your ultimate goal, like specifically in the mastermind. So we actually have 3 new faces with us tonight. So Derek, why don't you start us off?
Yeah, good. Can you hear me okay?
I got you.
Right. So my name is Derek Zerker. I'm originally from Australia. I am a geologist. I've been in the oil industry for 22, 23 years. Lived in 5 countries, been in over 50 countries in total, and ended up here in the US with a company called Baker Hughes. Got laid off in 2019. I had previously invested just small time in real estate. So I say I've been in real estate 40 years, even though I'm 51, because my parents bought a small office building back in Adelaide, which my brothers and I had the pleasure of cleaning every weekend. So I got to understand a little bit about offices. But since then, I've had individual rentals in Australia, in Florida, and then here in the US. I live in Houston with my wife. We live in a house here in a place called The Heights, where we have 3 small houses behind us that we rent out. I have been investing in townhome construction and started a project with 20 townhomes. The builder went bankrupt after 5, so I took over as the builder. In the meantime, I was doing rehabbing of small multifamily properties for another company. So I did get a little bit more construction experience through that. And so I've taken over as the builder, and I work, 10 to 12 hours a day, 6 days a week, trying to get my project out of the hole it's in to become, a success, which is slowly happening. And in terms of my goals, I'd like to step it up again to a new level and get, a decent size building project going on, maybe build for rent or multifamily, not sure which at the moment, or depending on what everybody's advice is, to actually go into what they call value add, which in my opinion is, the true value add for me is taking a piece of dirt and building on it. That's real value add. But in the multifamily industry, value add means taking something ugly and making it look nice. So anyway, that's my background, and good to be here. And I'm excited to see where we can go.
Glad to have you, man.
Welcome, Derek, for sure, man. I think it's awesome you took such ownership of that project. I think a lot of people like to wither up and crawl into a ball when bad things like that happen. So it's good. I'm happy for you to be part of the group, someone who takes ownership like that.
Thanks very much. Thank you.
Let's see, another fresh face. We got Brian.
So I'm Brian Meyer. I'm in Carmel, Indiana. So I'm a pathologist. I was in school until I was 32. And once I got out, I quickly learned that I want to get out of that career. So I've been doing it for about like 5-6 years. And now I've realized that after working 60-80 hours every week, that it's not for me. I'm missing time with my kids. So I want to change my path. It's kind of sad, but after all those years, but that's what I want to do. As far as experience, I don't have any real estate experience. I have a primary residence, but that doesn't count. So I'm looking to learn a lot. I'm looking to be pushed. I'm looking to get out of my comfort zone. I'm looking for like action items. I learned best through mentors. I learned best through people that have done it before me. So I'm kind of looking for guidance. And I mean, I know I'll be successful. It's a matter of when. But my goal is to be out of my current job in the next 4.5 years.
Boom.
That's awesome, man. I know it's nerve-wracking when you put so much time and dedication into a career just to leave it, right? But I would say very few people start in real estate, right? Most of us start in some other career field and then get thrust into real estate one way or another, whether it's passion or requirement. So welcome, man. Welcome for sure.
Hey, Brian, we're basically neighbors. I'm in Zionsville. Hey, yeah.
All right. What's your name? Chris? Okay. I'll send you a message. I love Zionsville. I lived there for a year.
Woo woo.
That's an awesome town. Okay.
And we got one last fresh face before we jump in, and that's Deepak. Is it Deepak or Deepak? Did I say that wrong?
Yeah, it's pronounced both ways. Yeah, as long as it sounds okay. So yeah, but people call me worse, so it's fine. So yeah, hey guys, this is Deepak. I'm an electrical engineer. I did my master's at USC, and then I work at Apple. My background is not real estate. It's chip design, but I've got good enough exposure to the real estate space. Basically, my parents did a BTR back from where I am from in India. They built a 32 unit apartment back home, and they're reaping the benefits of it. And I've seen that firsthand. And right now, I personally have done single family homes. I've done duplexes. I've done multifamilies as an LP. That's where I started. And I've seen light at the end of the tunnel being an LP, and I want to transition into more of the active roles in the multifamily space. And yeah, looking forward to taking it to the next level, hopefully with this mentorship program.
Love it. Good to have
Awesome.
you, man.
Where are you right now, Deepak?
I'm from the Bay Area.
Okay.
I stay in San Francisco, close to San Francisco.
I figured working with Apple, but you never know with so many remote workers. So
Yeah.
cool, man. Welcome.
All right. Matt, you should be good for screen share.
All right. Let me get rid of these shirtless pictures of Josh that you sent me. 1 second. Here. I'm
Yeah, you
joking.
guys will-
You
you leave
didn't
those
send
on
me
there,
shirtless
man.
pictures. I just thought it'd be funny. All right. All right, guys. We are continuing, and gals, we are continuing the beginner series here is what we're calling it. If you, just as a refresh, so far we initiated with our creative financing overview. Then we went to discuss some, personal business basics. Then we did discuss more specific real estate company structure overview. And in the past 2 weeks, we've been going on over like high level deal overviews, like the actual roadmap from start to finish on a deal. So those 2 lessons should be really useful. So for someone like Brian, let's say, who's newer to the space and really maybe not quite sure how the different puzzle pieces fit, those 2 lessons should be a really good kind of overview for you to recap. Today, we're going to talk about insurance. After that, we'll get into some branding and marketing stuff, some capital raising, and then we're going to do maybe some sort of role play recap thing. We're still kind of on the fence for what we're going to do for the end there. Maybe a little Q&A type session with some prizes or something. Who knows? We'll see. All right. Insurance. Man, that'd be a bad day if that was one of your apartment complexes, right? Insurance. So let's jump right into it. So why get insurance is the question. Insurance wasn't always a thing, but it has since become a behemoth of an industry, and insurance is a beast for many different reasons, and we'll get into various aspects of insurance. But as all of you are well aware, whether you're a renter or whether you own real estate, one or the other, insurance, or if you own a car or have rented a car or have done anything of significance in your life, I'm sure you bought insurance in some form or fashion. You understand that the main reason for insurance is to cover you in the case of some sort of a disaster. Insurance has a secondary benefit of more of a peace of mind factor as well. So we'll talk about that when you're discussing insurance. Some of it is some people will buy extra coverage just so they can sleep at night, right? So you're buying peace of mind as well as you're buying the actual coverage piece of it as well. But when we're talking about insurance itself, realize that every asset class is going to be a little bit unique based on the type of insurance needs or requirements within that asset class. So multifamily is what we'll focus on primarily today. And so we'll kind of get into the weeds of the requirements and kind of process and thoughts behind insurance in the multifamily space. But if we were to talk about, the more mobile home or RV park space when it comes to insurance, realize typically, owners are not going to have property coverage for a mobile home or an RV park. They'll typically just have some sort of a general liability coverage, some sort of a liability policy rather than actual coverage of property in a mobile home space. It's either not cost effective if you do own the mobile homes in a mobile home park, or you don't own the mobile homes, and the only thing you would be covering are the pads themselves and your infrastructure, which again, the coverage there is really almost unnecessary for the most part. So you'll typically see people will self-insure in the mobile home and RV park space versus the multifamily space. That's typically not even going to be allowed. Now, there may be some lending requirements we'll get into in some other slides with some caveats, but just to realize every asset class, when you jump into short-term rentals or medium-term rentals, you're going to have additional considerations there versus your traditional long-term rental stays as well. And realizing that when it comes to insurance, leveraging the platforms that you're in are going to be another thing to consider. So in a multifamily space, you're not necessarily in a platform, but if you jump into the short-term rental space like Airbnb or VRBO, like those things have $1 million policy for their hosts. So if you have an Airbnb, or let's say you're doing a boutique hotel, so you're doing a 10-unit hotel conversion that you're trying to do in a multifamily space, that's a traditional hotel now, and you want to convert it into a boutique Airbnb multifamily. If that's the case, realize that that is some coverage that you might be able to offset with your provider, because Airbnb and VRBO are going to cover you up to $1 million per stay per guest. So there are some things and caveats to realize. So that's another methodology to understand when it comes to the asset class of short-term rentals and medium-term rentals. When you jump into the office and industrial space, you're going to see a lot more triple net leases in that space, or master leases. And those leases are going to typically, you can effectively force your tenants to pay and have the policies that you're requiring. So then you can start to put requirements on your tenants at that point and ensure that your coverage is set appropriately. And then self-storage itself is going to have an entirely different consideration when it comes to how are you going to protect or cover the assets within your self-storage facilities. So all I have to say is that we're not getting in the weeds of each one of these, just realizing there are nuances and differences in each asset class. And so that's why we're going to want to leverage a broker or specialist or friends that are in the business to understand what we want to make sure we have. All right. And the next piece to understand is that the geographic location has a massive barrier and a massive impact on how the insurance is played out. We are seeing that real time right now with a lot of our properties. Our properties are mainly along the Gulf Coast, so Mississippi, Alabama, Florida, along the Gulf Coast region. In that region, because of the hurricanes, for whatever reason, the insurance companies have recently realized that hurricanes are expensive, and the premiums have damn near tripled for some of our properties. I think one of our properties, we were running like $70,000 a year, and our latest premium was $180,000 a year, right? So 2.5x what we were paying in a matter of a year changing is a significant change when it comes to kind of your NOI and bottom line. But you look at the other regions, every region is going to have their various, we'll say, natural disasters or their calamities they need to be prepared for. So it's just something to be aware of. The next thing is going to be understanding asset valuation. So Reggie, I'll let you talk to this one a little bit more, because I know you've kind of grinded with the insurance broker more on this piece, but do you want to kind of elaborate on, market value versus replacement cost and kind of understanding from a big picture insurance needs perspective there?
Yeah. Insurance is one of those necessary evils, and they've made up some rules, and they may or may not be great rules, but we have to play the hand that life's dealt us in this area. But we've learned a lot about this in the past couple of years. And so I think we're definitely not experts, but we did have to get into the weeds. We had a big claim, and that kind of just led us down this path of learning more about it. But when it comes to like market values and what you're insuring your property coverage as, before I got into multifamily, I'd really only had experience on the residential side. And that was a set it and forget it kind of policy. I never had to file any claims, never learned more about what I was doing. But with multifamily, there's different streams of income. There's, you have to worry about getting sued. There's general liability policies. There's these parametric policies that I think are specific to the Gulf Coast. There's all these little nooks and crannies here, but when you go to get insurance on a property, they're going to want to know how much to insure it for, and it may be different than what you bought it for. And that's based on the cost of materials, inflation, kind of things like that. Well, in the multifamily world, our net operating income usually dictates market value, but they're looking at replacement cost. And so don't want to, what's happening right now, because there's been a lot of losses, there's been equities flow out of the market. And to be honest, there's just been a few, like in Florida, for example, there were 5 insurance companies that went insolvent. So there's a lot less competition right now. So all of that has had kind of played a part here, but as a result, home prices going up, multifamily just kind of riding that same housing wave. Valuation is very high. And so insurance companies are looking at what they're valued at today. And so, it's just a little, I guess, insight on the market value piece, but we can get a lot more into the weeds later on there.
Yeah, that was a bit, just understanding when you're looking at these policies, what we're paying for versus what the insurance people are covering are exactly that, replacement cost versus market value. There is a significant difference there, and it's always a balance, right? You want to cover your investors for sure. At the same time, you don't want to overpay for insurance. There are also limits to the insurance companies for what they'll allow you to pay. So if they have a replacement cost of $10 million for a policy, oftentimes they'll have, I've not even gotten them to share us what their calculations are with how they have the replacement cost. Sometimes that's an internal proprietary system they won't share, but they'll say replacement cost is X. From there, they might allow like a 20% buffer over that for what they'll allow you to cover over that replacement cost if you do want to buy extra coverage there. All right, next thing, risk management. This is really kind of what we were kind of just talking about, though, is understanding that it is always going to be a balance of the amount of coverage you get versus the cost and the implications when it comes to NOI. Our job as general partners and as sponsors, as the investors in the mix here, we want to make sure that we are good stewards of the funds, and you can't just always try to put the pad to the pad to the pad to the pad. And when it comes to insurance, you might need to make some, we'll say, tactical cuts or intentional decisions when it comes to insurance, that you're going to accept risk sometimes in the near term to really not affect NOI as much as you need to, maybe to hit a certain refinance goal, or to hit a sale because you're trying to justify a certain NOI in the sale. So just realize there are times where you're going to make tactical decisions and accept a little bit more risk when it comes to insurance, depending on where you are within your kind of business cycle for your asset that you're jumping into. Anything else that you want to discuss before we jump into the next slide, Reggie or Josh?
I was just going to say, maybe you, as far as risk management goes, accepting a little bit more risk, maybe you bake that into the numbers on the get-go. So if you know you're going to just get a higher deductible, like, we'll just increase the deductible, so it's more out of pocket for us, less out of pocket for them. Lowers your overall premium, but now you're going to have a higher deductible when the claim comes. So maybe you just include that in the reserves, and then it's like more risk, but not necessarily, because you're trying to mitigate it. Definitely a balance. Yeah,
that's a great example right there. Deductible is one thing for sure that you can, one of the variables at play. All right. Jumping into the first main coverage this piece that we're going to talk to. We really broke it down in 2 aspects. So we're going to have liability and business piece, and then we have the property coverage. So when it comes to property coverage itself, in no particular order, understanding that one of the aspects of the property coverage that you're going to want to understand is the loss of business income. And so if a catastrophe were to happen, you want to make sure that not only are you protected when it comes to the replacement value of that asset, but you also want to be protected for the income that you're losing when those assets go down. Now, this is something you may easily overlook when you're looking at these policies up front, but this is one of those things that will hit you hard when you realize how long it takes to finally file a claim, to get repairs done, and then to re-lease up a building that may have been completely damaged that you had to evacuate the tenants out of. So when you're looking at this as a big picture variable, typically I'm going to tell you to try to get the longest period possible when it comes to loss of business income. on that front. They're typically going to come to in different durations between 6 to 12 months as far as options. But again, talking to your insurance broker to see kind of what is the max extent that you can extend this out to, and what are the implications when it comes to premiums on that front. Reggie, anything else you want to add on this one?
Yeah, just because you're bringing in 20,000 a month doesn't mean that they're going to pay you 20,000 a month on the loss of business income. We learned that in a claim that we had last year. And basically they look at your historical NOI and they use your rent roll calculations, and they estimate what they think you pay after they correct for loss of lease and vacancy and whatnot. And so you really, if you're really trying to project out scenarios and you're interested in the details, just be aware that there's a little nuance there.
Yeah, for sure. And well, that's that's the last slide we're going to get into here at the end is going to be expectation versus reality. So I'm not going to sugarcoat that one when we get there, guys. All right. Next thing to understand is there are what they call sublimits in these insurance policies. So sublimits meaning, yeah, you might have a protection of $1 million for this one building for, we'll say, catastrophic loss to rebuild it, but they might have specific sublimits within that building for, let's say, plumbing. So maybe they have a $20,000 limit per unit on plumbing. And this is where it could really bite you in the ass. We're understanding where, like, if you have common areas or specific equipment breakdowns with these various insurance claims, these specific sublimits could really come back to haunt you. So this is another area when you're reviewing your policies and your premiums, you want to understand for sure, hey, how much am I covered for big picture wise, but where are these carve outs? Where are these little cutouts that are going to kind of surprise me when we go to file a claim on that front? Now, the insurance companies realize they are specialists in framing damage in the best light possible for them and the worst light possible for you. So if you were to have damage from the building, they're going to come in there and they're going to do their damnedest to say that damage was not caused from the thing that you're covered for. That damage was caused by the thing that you're not covered for that has some sort of limit to it. And so this is where those sublimits are going to come into play on that piece. Reggie, Josh, anything else you want to talk on the sublimit piece?
Yeah, on that same claim, we had a plumbing failure basically in a 16-unit building. And they came in, the adjuster did his thing, wrote up his report, and they pulled out this obscure clause that says that there's a sublimit on damage related to sewer overflow. I said, hey, there's no sewer overflow. The water came down from above, and I talked them through it. They said, oh yeah, but as the water seeped down, it made the toilet fill up, and then the toilet spilled onto the floor, and so it was this far reach, and it was just really silly. It only knocked about $15,000 off our total claim proceeds, but still, just be aware of those idiosyncrasies in the policies.
Yeah, our property looked kind of like that photo.
It did a little bit, yeah. Cool. So sublimits, they're a thing. Just realize when you're reviewing these policies and you're talking to your brokers, just making sure you understand the sublimits and what implications they may play for you there. Next thing is, as a owner of a multifamily space, realize you can set requirements for your tenants to have renters insurance. And that sounds well and good, and that's awesome. And I recommend it as much as you can. But realize it does more than just protect your tenants. In that sense, it also protects you as a landlord in the case of, let's say there was a catastrophic failure of an apartment complex that you need to kick your tenants out. That is one where having them be covered separately on top of your coverage, you're almost doubly protected, right? They should have their own route and additional coverage that they can go through to have themselves relocated, or if there's damage to their specific property within your units, you're not going to be liable for it anyways. But they should be protected. So it's just prudent for you to push that upon your tenants and or make it a requirement depending on how you kind of want to manage your own properties. But one big benefit though is you could turn that into two big benefits of having your tenants have renters insurance. One, if you have 100% of your tenants covered with renters insurance, there are discounts that your master policy, your policy for your building itself, for your property itself, you could get discounts if your tenants have renters insurance, if 100% of them do, or a certain percentage, depending on how the policy is written. The other piece is you could turn that into a revenue stream yourself. So you could effectively charge your tenants for renters insurance through specific programs, and you could make that an alternate, an other income source, if you will. Reggie, do you want to discuss that a little more as far as making that an alternate income source?
Yeah, so depending on how big the property is, what management software that the PM is using, there's different ways of offering your tenants insurance, and it's really contents coverage. It may have some basic liability type stuff built in there, but basically, when you offer this insurance to them, you get a bulk discount, especially if you're paying for your old property, and then you bill them back. So it might cost you $7 per tenant that signs up, but then maybe you charge 11, and maybe that's not a big honking deal, but I mean, a few nickels and dimes add up to $1. And so if you have that spread across 200 or 300 units, it adds up. So anyway, just, the insurance carriers for your property coverage and everything else, they love that. It's very, very complimentary thing. So you can make some money off of it, and it helps to push your own premiums down. So it's kind of like this, this nice twofer.
Yeah, and so Matt, I know you asked the question of, hey, how do you ensure that they have it? It's tough to ensure that they maintain it. I will say that unless you're paying for it yourself as part of kind of what Reggie just alluded to, you can ensure that they verify upon the signing of the lease that they have an active insurance policy. But beyond that, it's going to be one of the two. You verify up front that you have some sort of payment. Looks like Josh just finished his little text to everyone, but that's going to be in a nutshell. So you can either verify up front when they sign the lease, hey, I have an active policy in place. And then after that, really, I'm not going to do like quarterly updates. Hey, show me your renter's insurance. It's just an unnecessary administrivia there. Or if you're paying for it yourself, you're paying for it. And so you're good to go on that front. All right. Next one, catastrophic loss. Understanding that catastrophic loss is one of the main reasons that we have property coverage. Catastrophic loss meaning, hey, this property is no longer livable if it is a multifamily thing. This is really the major events that we're talking about this one, volcanic eruptions, earthquakes, tsunamis, hurricanes, tornadoes, wildfires, name whatever large natural disaster that's in your area. And that's what this is discussing. Now realize most of these major events are also, to Josh's point earlier, going to have some sort of separate deductible. So if you're in Florida, you have your normal deductible, or along the Gulf Coast, we'll say, but you also have your separate catastrophic deductible, or we call it hurricane deductible, along the Gulf Coast. So just understanding what that deductible might be and how that plays out into your reserves, like Josh was saying, is going to be a big player when you're talking about kind of your pro forma and understanding risk reward. That's going to be another variable to consider when you're looking at these property coverage variables. All right. Now, on top of that, as you're looking at these property coverage, you're going to have two major players trying to get their hands in the mix when it comes to what are the requirements. The first one's going to be your lender. The second one's going to be the property manager. The lender is going to, as the mortgagee, that is the lender themselves, as the mortgagee, they want to protect themselves, and they want to ensure that at least their money, their investment is protected to the max extent, at least. So they're going to have specific requirements. So when you're underwriting a deal and you're talking to the mortgage broker, you're also going to get the mortgage broker's requirements and throw that into the mix with your insurance broker. Just realize that they will have specific requirements they're going to want to see there. Same thing when it comes to property management requirements. If you're working with a larger scale property manager, they will typically have additional requirements for their own daily operations that they want to see carved out, either specifically for them as an additional insured under your policy, or they might have some specific items they want to ensure that are covered to ensure that they, it's a classic CYA when it comes to property manager insurance requirements there. Cool. Any specific or any other additions, Josh or Reggie, on this one before we move on, or any other questions, guys, when it comes to property coverage? Cool. I know insurance is a really dry topic, guys, but it's an important topic to understand. And it also, the insurance industry intentionally makes insurance convoluted and scary and confusing. So we'll do our best to try to make this as vanilla and as possible for you.
Hey,
All right.
on that note, real quick, Matt,
Mhm.
I just wanted to say, like, you know, with insurance, it really helps to have a relationship with your agent. They can really go to bat for you on a lot of stuff. So just keep that in mind. And like Matt said, it is pretty dry, but it's really pays to be familiar with it just in case something ever happens.
Yeah, absolutely. Liability. All right. So one of the coverages you're gonna want to have multiple general liability. They call them GL policies. They're going to cover you for if you're getting sued, classic slip and fall, injuries, damages. And then we're going to jump into other forms of liability insurance, which are going to be your business insurance needs, errors and omissions, cyber, and all that fun stuff. This is the classic slip and fall policy, like I said. On top of this, if and when you do get sued, the nice thing about most general liability policies is that there's no premium, there's no deductible to them, right? It's an add-on to a policy, your property coverage, that if and when this happens, you shouldn't have a deductible coming out to pay for the attorneys when these things happen, which helps prevent like frivolous lawsuits as much as we can prevent them. All right. When it comes to liability as well, in your PM contract, they're going to try to limit their liability as much as they can by having certain hold harmless aspects to it in their contract. I know, Reggie, this is one point you wanted to discuss, right? It was the hold harmless with the property manager.
Yeah, you know, some people call it hold harmless. Sometimes it's captured under this indemnity clause. Indemnity is fine. Just make sure that it's mutual, and just make sure that there's nothing that, you know, encumbers you unnecessarily. And likewise, I mean, you want this, you want it to be a balanced, you know, type of contract. So just be aware of some of those little clauses as it relates to insurance.
Yeah. Next thing's going to be business insurance. Understanding, depending on your asset that you're purchasing, and whether you have auto, when you already have, if you have specific W-2 employees at the property, workers' comp is going to be a factor. You're going to have, if you have company cars that are part of the, or golf carts or whatever happens to be, different vehicles that are part of the larger complexes, you may need specific insurance needs for those, as well as, you know, just general umbrella policies to protect you for any other catch-alls, right? This is the common picture you see with insurance, is some sort of umbrella to protect you for these just rainy days, if you will. And so again, working with your broker and your attorney to understand, hey man, where are my risks in here? Talking to your attorney, and then how can I mitigate that? Talking with your insurance broker is going to just, again, this is what's going to help you sleep at night. And when you do, someone does try to screw you, hopefully you are protected with your insurance needs there. Errors and omissions is going to be another form of insurance you're going to want to consider. This is when when mistakes are made when it comes to you know, professional mistakes. Errors and omissions meaning like literally you're just oh, I accidentally wrote this in wrong, or I failed to fill out this one form that was required. So errors and omissions should protect you from a liability perspective on any sort of failed, like again, professional mistakes is really what it is for. After that, we discussed this briefly a couple of weeks ago, was the cyber coverage. This is something that's getting bigger and bigger. Understanding that you're going to have a lot of PII, or personally identifiable information in your hands, right? As part of your emails, part of your databases, whether you have these various shared drives, whether it's OneDrive or Google Drive that on the different cloud services, you're going to have access to people's personal information. Whether it be banking information, social security numbers, addresses, date of birth, you know, when you combine all that stuff together, that's a significant source of information that people can leverage inappropriately if it gets out. And so you want to safeguard your digital assets to the max extent. And one way you can safeguard that is if for some reason you do get hacked, or you do get some sort of malware, or what's the other one where they encrypt all your stuff, and ransomware. Ransomware is the other one where you got to pay them to unlock your data. All that stuff can be covered through an additional insurance cyber coverage, which as of right now, the cyber coverage is fairly cheap. And just one more way, again, to help you sleep at night if for some reason something were to get messed up in regard to cyber and getting hacked, which, you know, is a threat that's going to continue to grow and grow as we continue to make cyber being a massive part of our businesses.
Hey, Matt, I've got a really great quick example of that.
Yeah.
When I was, you know, full-time oil and gas, I spent some time in Denver in our corporate offices. And one day I always worked remote, and one day I wasn't able to get a hold of anybody, and email stopped working, and we had gotten hacked, and our entire system. This is a $2 billion company, global, just got completely shut down. And long story short, we got hacked literally by the Russians, like literally. We had Homeland Security involved, FBI. 1,800 people had to send in their laptops to be personally scanned. Yeah, it was a big honking deal. They ran this company off a chalkboard for a couple of months as we kind of piece things back together. But that's like an extreme example and not completely applicable to what, the considerations you have in multifamily, but it happens. And so it's, better to be prepared than sorry.
Yeah, absolutely. I mean, some of my good friends were, professional hackers in the Air Force who would hack people's cell phones from airplanes, right? And so you can get hacked fairly easily. It's definitely a thing. And I doubt I don't know, I'm not going to speak for everyone except for Deepak. Deepak probably has some pretty good stuff as he's like designing computer chips over there. But the rest of us, I'm assuming, aren't the best when it comes to cybersecurity. I'm just going to throw that out there as a guess. All right.
Well, so the cherry on top, Matt, is they had cyber coverage. And I think the company ended up filing like a $17 million claim or something like that. It was very high, but they got it.
There you go. The benefits of insurance. Derek, you have a question? Good.
Yeah, sorry, a quick one, especially on my side. If you're doing a rehab or construction, obviously builder's risk is probably the main insurance you're going to have. And you're not so much looking then at loss of income as so much as loss of sales. You're looking at theft. You're looking at all the natural disaster stuff you talked about already. Pretty easy to find out how much you're going to be covered for, because it is literally, the value of the construction or the loan you're getting for the construction.
Yeah.
So, and I've dealt quite a lot with builder's risk. So that's an important one.
That's a good point to bring up, because sometimes you'll transition these coverages, right? Let's say you do have a catastrophic loss in a property. You will transition while that property is being built. You'll transition from your traditional insurance coverage to then builder's risk policy while it's being built back out. And then you'll plan on transitioning back to your traditional coverage. So you will kind of flip-flop between coverages because they all play different roles for different times. So that's a good point. Thanks, Derek. All right, let's talk about how to actually do this. Reggie, if you want to get your email queued up or whatever you want when it comes to this, Raj. So how do you start the process for an insurance? So let's say you find a property, we're doing our due diligence, you're getting ready to go, and you want to start to engage an insurance broker on how do I get a policy set up? And the first thing you want to do is, find a partner to work with when it comes to insurance brokers. Now, we've talked about relationships and the important relationships in this business on multiple aspects. We've talked about why it's really important to, make friends with mortgage brokers, why it's really important to make friends with the actual real estate brokers in your area who are bringing you deals. And this is one more emphasis or highlight for why relationships are key in this business. If you start to really develop a good relationship, a working relationship, almost I will say a casual relationship with insurance brokers, there's going to be the same benefits as it is with the other relationships in the business. So as you kind of develop this core community around you, it really makes your life that much easier, rather than every new deal you're like, okay, does anyone have an insurance agent I can talk to? I got a new deal under contract. Like, you want to have your one go-to guy that you can really leverage it to your max extent. Now, you're not always going to use them every time. And they understand that it's part of the business. You can't always use the same person for every deal. But by having this personal relationship, they will gain more business from you, but they realize it's not going to happen every time, because it is a business relationship. Sometimes they don't even have coverage for you, depending on what the aspect is that you're asking to be covered. So this really comes down to asking around. There's not a ton of commercial real estate brokers, I'll be honest. So it's a relatively small community. At the same time, there's even fewer commercial real estate insurance companies. And so there's a lot, there's brokers, and these brokers are going to be shopping around the different agents, the actual companies within them. And I don't think I have a separate slide for it right now, but what you'll see is you don't want to shop around too much, though. We've talked about this before, because whenever you have, let's say you go to broker A, and broker A is going to go and talk to I'll say Allstate as an example. They're going to go talk to Allstate and to kind of underwrite a specific deal. And then broker B, you talk to as well to show them the same deal. And broker B goes to Allstate. Now, let's say broker A frames your deal in a certain light, and then broker B frames your same deal in another light. Allstate's then going to start to get pretty pissed off at that point, because they're going to be like, you're telling me this is the same address, but you're saying like this could happen here, and you're saying this could happen here, and they get pretty frustrated. Sometimes they don't even want to see the deal at all. You kind of sour a deal by shopping it around too much. So you can talk to your insurance brokers, ask them what companies they go to, because they'll have a certain set of companies that that are kind of their go-to, and you can try to deconflict it that way. But really what it comes down to is finding one good insurance broker to hopefully do the shopping around for you is ultimately the goal. But at the same time, always kind of dating around in the back scene as much as you can. Does that make sense, guys? So like primarily you could shoot yourself in the foot if you shop around too much. Anyways, just realize that. And when it comes to finding brokers, it really comes to asking around is the best that I found. So being involved in the various forums, whether it be Bigger Pockets, whether it be various Facebook groups like this, we're happy to share any of the insurance brokers that we have. Our brokers might specialize in the Southeast and in the specific areas here. So they might not be the best for someone, in the Bay Area out in California, because there's different considerations out there in California. But, just being involved in the various groups. And if we can't find someone, we're happy to help you try to chase down people as well, because the bigger our network it gets, the better we are and the more valuable we are together. So any other things, Josh or Reggie? I'll say Josh for this one potentially. You have any other recommendations when it comes to networking for insurance brokers?
Networking for insurance brokers. I don't know. I mean, they're all over the place. LinkedIn, especially. That's just been a platform I've used heavily for networking in general. And honestly, you could just post something and say, hey, I'm looking for an insurance broker for XYZ. And if the broker themselves doesn't actually reach out to you, you'll probably end up finding someone else that's used someone that they like that'll introduce you to someone else. It's literally just basic networking as far as insurance brokers go.
Yeah. All right. So from there, we found a broker. Now we have a property. We have a broker. Now, how do we actually engage? What does a broker need to see when we want to engage with a traditional multifamily? Reggie, are you want to screen share, or what do you want to do for showing what you got here?
I was not able to find kind of my boilerplate email, but so Matt touched on this, but we have a great relationship with our current insurance guy, and so we've gotten to the point to where I forward him a rent roll and an offering memorandum, T12, and he gets he can ballpark it and then kind of fine tune it as we go along. But I mean, it starts in underwriting, but you basically just want to give him the fundamental information about the property. Now, if you have this good communication, this good relationship with the broker, then you can say, hey, I'm looking at this building. This is the year it was built. Here's the city. Maybe give him some little background details, and he'll ballpark you. He'll say it could be anywhere from $500 to $700 a unit, or I'm getting $300 to $400 a unit in Nashville or wherever. But it really comes in handy to have somebody like that. But just that basic information, get over to them first off, and get you the ballpark. And then you tune it as you go along. And then the quote usually doesn't come until about 30 days before closing, give or take. So it does take them some time. And right now, with the way the insurance market is, like right now we're waiting on a renewal, and it renews in 10 days, and we still haven't gotten a number. And because the carriers are waiting to the last minute to do stuff. But yeah.
Gotta love it. Gotta love it. It's always stressful with these freaking renewals. I wish we had a better way to streamline it. But to Reggie's point, they honestly won't even entertain giving you numbers until 30 days out. So you could try to lean forward as much as you can, give them all the data. I'm not trying to say don't give them the data, but they really won't start engaging until about 30 days out. And then depending on how busy they are, their current season, you may be waiting till the last minute. And sometimes it is a white knuckle finish as you're just hoping to make it happen. What they're going to want to see, to Reggie's point, they want to see the basic stats in the property. They're going to want to see ideally the offering memorandum, the T12. They're going to want to see the rent roll like we have listed here. So rent roll, they want to see like the actual payment history of the tenants in place. And then specifically, they also are going to want to see the loss runs. And so loss runs is something you request from the seller, and that's going to show the claim history for that specific property to see if is this a Is this a problem child property or is this a property that has been relatively clean? Reggie, how far back do they typically ask when it comes to loss runs?
1 year is a minimum, 3 years is good, 5 years is great.
Yeah, so if you can show a 5-year history of loss runs in the property, that would be ideal. But yeah, 1 year for sure at a minimum. All right, now when it comes to, is there an ideal time to buy insurance? Now realize you kind of have some wiggle room depending on how your policy is structured. We'll talk about payments next when it comes to payments for insurance policies. But is there an ideal time to buy policies? And the answer is yes. But it also is yes, it depends on what area you're in. But typically, the best time to buy insurance is going to be in January. So in January, there is the company is going to have effectively new fiscal years is set, depending on how they run their fiscal years, if it's a January through February, October through October. So new fiscal year, a new budget's going to be set for them. So new quota when it comes to that regard, as well as January is a typical time that when it comes to natural disasters are at a minimum, unless you're in the north. So like hurricane season's finished just for us in the southeast. And so a lot of the major headaches that insurance companies are dealing with from June all the way through to November are finally settled in December. End of year is done. And then January, honestly, is a pretty great time to be shopping around for new policies. You'll typically see rates, dip a little bit in January. Reggie, anything else to add when it comes to time to buy or benefits for that regard?
No, you touched on the good point. It can be geographic, but for the most part, January is the month. And another reason is because that's when reinsurance rates reset. It's something all the agents have told me about, but it basically affects their internal return metrics. And so it affects those return metrics. And so when those new rates come out for the reinsurance, because you can buy and sell insurance behind, like the carriers can, they can sell policies. They look at that and they say, okay. And so they may adjust, that they know what they have to work with for the year, basically. Yeah. And they're not getting towards the end of the year and trying to hit other goals. So it's just a great timing. January is.
Yeah, and then depending which we'll talk about here short. Well, I think it's the next slide. We're going to talk about minimum earned premiums. And depending on where you are with your minimum earned premiums, you may be able to shop around, even though you just bought a policy 4 months earlier. All right. So that's starting the insurance process. Any questions on just kind of that initial intro, guys? How to get a policy rolling? Sweet. Super interactive today. I love it. I said sarcastically. All right. Let's keep rolling. Understanding payments. So when it comes to payments, you effectively have two options in the multifamily space, in the commercial space. You have the annual payment option, which is the lump sum. The advantage of paying a lump sum is you are not trying to finance it whatsoever. So you don't have the additional fees when it comes to the other option, which is financing it. There are specific companies within the insurance companies, they'll push you to their specific preferred financing companies. You're typically looking at roughly a 7%-ish interest rate on the cost. The benefits to financing is from an accounting perspective, from a bookkeeping perspective, you have your set payment every month, right? It's a very tried and true. Hey, I'm paying this much every month for insurance. For some of us in the group that have a hard time building up reserves appropriately over time, the annual payments could come to bite you in the ass if you're not expecting it at the end of the year, right? So just it comes down to, if you can plan properly and have your annual payments up front, that is what I would highly recommend. But if not, there are times where just financing it is going to be the right option. When liquid capital is at a premium, I would rather take a financing option than need some sort of a capital call, if that makes sense. So if you're in that position, that's going to be something you're going to need to make as a general partner. Like, what is my correct decision? Do I make this a little bit more expensive for the property, or do I kind of lose a little bit of faith with my investors and say, oh guys, I forgot that our insurance is due now. I need everyone to pony up 10 grand or whatever it happens to be. Or you personally, as a general partner, you fork over that dough yourself to keep it liquid for your investment. That's another option you can do. But again, in the grand scheme of things, I'm going to choose the financing option to make that work if I haven't planned appropriately, or something else happened that kind of made us not as liquid as we should be. All right, so that's your kind of your basic two options of annual payment versus your monthly payments is what it comes down to there. Now, when you do go to sell your property, realize you will have some if you have an annual payment in place, or even if you have the financing option in place, you're going to need to claw back that money from the insurance provider, and sometimes that is much more difficult than you may realize what it is. Reggie, I know you wanted to kind of touch on this one as well, as when it comes to clawing back money from the provider upon the sale.
Yeah, we were set up with one of these third-party financing programs, and we had an asset for sale, and the sale hadn't consummated yet, and it was time to renew, so we had to renew. I did have the conversation with the agent about that, just making sure that we would get reimbursed at a sale, because of the whole minimum earned premium thing. But he alleviated my fears there, but we didn't talk about, what happens because we finance it, and how, the logistics of the money flow, the cash flow. And so we ended up selling a property. I think we closed in, was it April, guys, or June? I feel like always,
I think it was June.
Anyway.
Who knows?
Yeah, I was like,
Citronelle. I think that was April.
yeah.
Oh.
Okay. We'll say Q2, closing Q2.
Yeah.
And and for another month or two, they kept drafting the count. And so we had conversations about it. Long story short, ended up finally getting a check on like December 28th. Like, it almost dragged out into the next tax year. And that would have caused us to have to keep the LLC open for another year, file another year of taxes, et cetera, et cetera. So I basically threatened our agent, and it was an accounting error, I think, but our money was tied up for 8 months, and it was, it wasn't a huge sum. It was maybe, $4 or $5 grand, but it was non-trivial.
Yeah, it's annoying for sure when you deal with some of these people. But that is a good segue into the minimum earned premium. Understanding that one of the benefits of dealing with insurance companies is, while you might sign, some sort of an annual contract with them when it comes to insurance coverage, typically, I would say typically, because we've been bitten in the ass when it comes to trying to reduce our premiums, they will have a minimum earned minimum earned premium, meaning there is going to be some sort of non-refundable portion when it comes to that. Call it 2 years ago, 3 years ago, it was very common across the board that most minimum earned premiums were 25%. Meaning if you held with them for 3 months, you were at the break-even point after 3 months. And then after that, you can cancel, renew, do whatever you have to do after 3 months. And it was a no-brainer, easy peasy. But where we stand now, you're starting to see a lot of these policies shift to really being a 75% premium, minimum premium earned. We've even signed policies for 100% minimum premium earned because it was a requirement, and we had no other options. Because insurance, again, they put you in that square corner where you only have 30 days to make decisions, and you kind of get put in these awkward positions where you just kind of fight or flight at that point. So
hey, I'm sorry to interrupt you, Matt. What do you mean minimum premium earned?
So when it comes to minimum, let's say your policy is a $50,000 policy, right? So that to cover your property for a year, you're going to do the annual payment of $50,000. And so whether you're doing the financing option or the annual payment, it doesn't really matter. So let's say we do the annual payment. We pay the insurance company $50,000.
Right.
3 months later, or we'll say 6 months later, we find an even better policy. Or let's say 6 months later, we go to sell the property. We want that half a year back.
Right.
So if we have a 25% earned premium, we can get those 6 months back, no problem. So they'll give us a refund of $25,000
Okay.
when we go to sell the property, or if we go to get a new policy, whatever it happens to be.
Yeah.
But if they have a 75% earned premium and we sell it at month 6, they'll say, thank you very much. Here's $12,500 back. Because that's the most they're going to refund us, is that.
Oh, I see. Wow. And then so a moment ago, Reggie was talking about, let's say you've paid this premium, like you're saying, and let's say, I had to renew it, right? But now market hit, like, let's just say this was 2022 last year, and we're hitting a top, and we're like, you know what? I've got somebody who wants to buy this property. We've already done our value add, yada, yada, yada. We can definitely get this payout from this deal. Because the fact that you're still waiting for that 6 month return, since you're going to have to chase and claw and fight and scream and bitch about it, do you go ahead and just pay out your LPs, and then you just wait for the back end for the GPs, that deal, right? So it sounds like it's happening.
So yeah, I mean, you're basically you're talking about tidying up upon a sale, right? So if you go to sell, like how do you account for the unknown variables of expenses after the sale?
Right.
That is a tough one to calculate. You do your best you can because there's always unknown variables at play, and you intentionally hold back more than you think you need.
Okay. Oh,
and
that's
so
right.
the
You guys talked
conversation-
about this a couple of videos back. Okay, I remember that. Holding a portion of that. I think you guys wrote that there was a percentage. It says like hold back about, I don't know, a certain percentage to cover those things. And then, okay, that's right. Sorry. Thank you.
No, you don't need to put, that's a good question, because I mean, that really comes into this whole minimum earned premium, because kind of like what Reggie was talking, if you were to go sell a property and your insurance renews, like we'll say a week after closing, you're like, okay, we can't delay closing because if we delay a week, I need to get a new insurance policy. And we know that insurance policy is going to have a 25% minimum earned premium at a minimum. So you're paying for 3 months of insurance you know you're not going to use.
Wow. Yeah.
And so their timing does come into play when you're discussing this.
I have one last follow-up then.
Yeah.
Are there insurance companies that will do a bridge? Like, okay, like you said, okay, we can insure your whole thing for a month or something of that sort. But obviously they're going to need to go out there, inspect the entire thing, because they're going to go ahead and put their premium on the line for a $5 million policy. Do they do that for like a month and just charge a fee for that, like a higher fee?
This is
No,
one of the things when you're negotiating with the insurance policy, which I think we get into next. Well, that's a good segue. I'll just kind of transition here, right? So
Sorry.
negotiating terms, that's one of the terms that you can negotiate with, like, what is my minimum earned premium here? And so you can say, okay, I only want a 1 month minimum earned premium. Then say, okay, well, this is what your premium looks like then, if that's the case.
Right.
And so they're going to increase their premium to make that happen. You say, okay, well, what if I really increase my deductible now? Like I want to double my deductible, accept a really high deductible. Like, okay, then maybe that'll drop your premium down a little bit more. And so again, it's playing that balance of risk and reward when it comes to understanding really what is flexible when we're having these conversations with your insurance brokers. And so I'll kind of hand it over to Reggie for this one, to understanding, like, Reggie, do you want to kind of, if you can give the guys a big picture understanding of what are some of the more common flexible negotiating terms when we're discussing terms with an insurance broker, and what are some things that you found to be a little more stringent or not as flexible?
Thank you.
Yeah.
There's actually a lot more that's negotiable than you'd think. Like for instance, minimum earned premiums are one. And it's just a risk reward ratio. Do you want a lower premium, or are you okay with less coverage? You can exclude, you can get them to exclude anything as long as they bid up into a contract. But the things that I've worked on before, like a lot of times they'll put these I don't know, I call them like time bombs or grenades that you don't realize how much they can impact you until they do. But there's a thing called wind-driven rain, and it's not damage from floodwaters. It's not damage from storm rains. It's like, literally wind-driven rain instead of just naturally falling by gravity rain. I know it. So they'll nestle these little clauses in there that say, okay, if it's wind-driven rain, if the damage is caused by wind-driven rain, we're not going to cover it. And they'll do everything they can to kind of argue that, this was obviously wind-driven rain because it went up under the soffit and leaked into the wall, or, it's again, they kind of reach for some of the stuff. But, there was another one where, I talked about the one with the sewer supplement.
Yeah.
But all those little things are flexible, and you can just have less coverage. But if you have any kind of lending, if you have any kind of debt on it, it'll be, your bottleneck will be the bank's requirements. So, but everything's negotiable basically with your insurance folks.
Yeah. So that's a good point. And that brings us to the exclusion piece. So he talked about the wind-driven rain. Another common one you might see on your policies, that a way that insurance providers can make more money by making it seem like you need coverage when it may not be as required. So it's important to talk to your brokers to say, what does this mean? Like, what is the situation where this coverage would actually be applicable to me. And like, if I remove this, what is the risk that I'm actually inducing here? Assuming your lender and your property manager like can agree to that coverage, can I remove this and still sleep well at night, know that I'm doing what's best for my investors, but also maybe save a buck when it comes to NOI and increase the value of my property? For instance, one thing is terrorism coverage you might see on your property is. Now, terrorism coverage sounds like good, right? If terrorists come and blow up your building, you want to make sure that that's actually covered, right? I want to make sure I'm covered if some extreme example happens. However, you got to realize when it comes to terrorism coverage, that's only if like the federal government declares that specific act to be a terrorist act against the United States. And the amount of times that it has happened is like 3 times in the history of the US or something like that, right? So like the likelihood of that, this terrorism coverage, even if someone comes and says they're in some holy war and they want to blow up your building, then that may not be still considered a terrorist act according to the government. And so you may not get the coverage there, right? So just understanding what these coverages are and how minimal they may actually be applicable to your situation. Sinkholes are another one. So like in Florida, the state of Florida, for every insurance policy requires sinkhole coverage to be there, which is kind of what we all think of as like catastrophic loss in case of a sinkhole. If my building gets sucked into the ground due to the sinkhole. But there are also areas, there are also certain coverages in Florida they'll call sinkhole coverage, but it's really just additional coverage that's almost not even required at all, because they're trying to make a little bit more money on additional what they call sinkhole coverage, which is really just kind of concrete shifting, which again is really not going to be as applicable to what you're concerned about. So again, as you're reading through these policies, the importance of having that relationship that you can just leverage your insurance broker up front, be like, hey man, what is this, right? You're going to do your Google, you're going to go to ChatGPT and ask ChatGPT what it is. But after that, to get the down and dirty, like, am I going to ever use this? Like, what is this? Can you give me the scenario when this could be used? So you can understand these exclusions and whether you care about the exclusions or not.
Hey,
Cool.
Matt.
Yeah.
I have a quick question going back to what you were explaining. So, I understand that you can negotiate and, maybe you want a higher deductible to reduce the premium cost, all that. But in most cases, would you guys really insure building below the replacement cost? So meaning if something, if there's a fire and you need to rebuild it, you would not have enough funds. I mean, is that common, or it's just in a case where really you're short of cash and it's like an extreme case?
I will tell you what's common is we really, it's tough to determine replacement cost of a Class B or Class C asset. To be honest with you, that's where we struggle the most, is understanding what is the replacement cost going to be, because your lender is going to want to justify the highest replacement cost possible for their requirements, and your insurance broker is going to be like, no, I'm giving you $250 a square foot. I don't know, Derek, what are you building your properties for right now? I'm just curious, your rough price per square foot.
Probably in the 120, 130, 140 range. It's I used to be in the 80s, 90s dollars a square foot back in 2017, and now it's, but I'm self-managing, right? So I'm not paying a GC. I'm managing everything. And the other thing to consider is, I don't know how the foundation works when it comes to replacement, but maybe the rest of the place will burn down, but you may still have your foundation.
you may, but when I think catastrophic loss, I think I'm starting from the foundation up, like everything, right?
Right.
Sewer and on up. So so Oliver, to your point, I think one of the things that is tough, is understanding what that replacement value is going to be, and it's almost a gut check. Like you talk to people like Derek who are actively building right now, and they might tell you, man, conservatively, if you're going to use a GC, we'll say 160 a square foot. Derek's probably confident he can build whatever he's building right now if he needs to be. But your insurance broker might be like, no, here's the data. We're going to offer you, our replacement value is roughly 120 a square foot. And your lender might say, man, we're requiring 150 a square foot. And so you're like, well, what am I comfortable with? And what am I actually allowed to buy? Because the insurance company may not let you buy $200 a square foot, even though that's what makes you feel comfortable. And so it's going to be a balance of understanding, hey, what is my window that I'm allowed to buy? What the insurance company will allow? What is my lender requiring? And then, from there, it's your comfort limit. Like that's the risk reward profile. That you find your window there, and then you got to figure out your risk reward profile for what you want to get covered within that window. So you may not to your question, you may not have the ability to underinsure. At the same time, you may almost be forced to underinsure in certain scenarios because that replacement cost may still be well below what the actual replacement cost is. Does that clear up the question a little bit?
No, it doesn't. Just a little point. It's funny because so here in California, I just built a house and I'm at $400 a square foot.
Yeah.
Which is kind of the range here. So, and as a matter of fact, the insurance company canceled my insurance policy 2 weeks after starting it because they did not believe that was my actual cost. So exactly what you're saying. This just happened to me. So now I'm actually
That's crazy.
I need to prove to them that was my actual cost.
Yeah.
So yeah, but I just wanted to make sure that, in some cases you could be comfortable with underinsuring, or at least compared to the replacement costs. Because to me, that seems like a stressful thought,
It is, and that's part of the again, this is all that what if scenario that hopefully you never need to go down. But we've dealt with it personally with our properties, with multiple properties. We've dealt with insurance claims, and whether it be we're getting sued by the mayor of a town because of frivolous lawsuits, where you're dealing with the liability piece, or you're being sued by the tenants for inappropriate evictions, or actual damage that we're dealing with, whether it be roofs of properties that we're taking over insurance claims that we've done that before that are actively in place, or we have to start the claims process from start to finish ourselves. We've kind of dealt with the headaches in pretty much every aspect you can consider at this point. And it's just one of those things you need to do the best you can to be comfortable. Like I said, insurance, one of the reasons for insurance is that you can sleep at night. So for you owning your personal residence right now, if you find that coverage for $400 a night, or for $400 per square foot, you're going to be able to sleep soundly knowing, worst case scenario, if your house catches on fire, you can rebuild it, right? But if you get coverage at $300 a square foot, maybe you just now have those reserves in place, man. Like worst case scenario, I need to throw in an extra 200 grand to make my house back to what it was. That's just the situation you're in. At least you're aware of the situation, or hopefully that, you find cheaper labor next time. I don't know. Cool. So the claims process now is understanding that, I say preparing for potential disappointments here, meaning you will be disappointed in the way that insurance companies handle your claims. Now, this is where it comes in. You still want to have a good relationship with your insurance broker, your insurance agent, right? Because they are still going to be your go-to when it comes to this. But they are handcuffed by their company policies and the bureaucracy behind the closed door of the insurance company itself. And so just prepare yourself for disappointment. That's why I have this whole expectation versus reality, right? This is what the insurance company is selling you, this big, juicy Big Mac burger. And then you go to McDonald's and what do you get? You get something like this, some floppy little thing that you're like, what is this? That's not what was on the picture, right? And this is a really good comparison to like insurance companies before and after a claim. Like, this is what we'll get you covered for here. And then reality hits. That's when you realize the exclusions these little grenades that Reggie was talking about start to really suck. So just prepare yourself mentally for that. And then the other piece is, as you're going through these claims processes, realize that a lot of the time you're going to need to front the money in order to pay for these repairs. And then the insurance companies are going to pay you back afterwards. They should pay you back afterwards. And so just realize when it comes to having the CapEx and the reserves in place, one of the things that we hold in place is going to be, we'll have an insurance deductible plus 6 months of mortgage payments. And so that is kind of our comfortable minimum to hopefully is going to be enough. If something were to happen, we will leverage that money to then fix whatever we need to fix and then ask for the insurance company for the money back. So just realize it is a process where even though the insurance company should cover you, you are going to be required to have money out of pocket during this claim process. There are times where the insurance company will pay directly to the contractor or for materials, but I'm not going to hold my breath for that. You're going to want to get the work done as much as you can. Reggie, any other additions you want to fill in on understanding the claims process when it comes to payments and pulling money from the insurance companies, or any other additions there?
Yeah, well, this is another area that's negotiable. So it's not customary, but you can go and say, hey, I need an emergency, advance on whatever my claim might be. And they might do it, but begrudgingly, but they'll do it. The claims process, just just, it's going to be frustrating, and it's very bureaucratic. So you have your agent who goes to carriers and solicits for you insurance, but when you have a claim, they send this to a third-party administrator or a TPA. All right, so now you have 3 people involved outside of yourself, and then they hire an adjuster. And the adjuster is kind of beholden to their own company, but they work for the TPA. And it's a spaghettied network that's intentionally designed to make it so difficult to dispute anything that most people just give up and quit. I feel like we were on our claim, we were probably more aggressive than most, but I still think we left money on the table. Because but basically when we got to the end of our claim, they said, look, we're only going to send you this payment if you sign this form saying that this is completely closed out. And even if you find something more down the road, you won't call us back. So.
Yeah. I will say the greasy wheel gets the oil in the case of insurance companies, but the squeaky wheel gets the oil, but that wheel needs to squeak for a good often and for a long period of time. It comes to sometimes it's who's going to outlast the other person when it comes to complaining and kind of speaking up. I wish we had a better process for this. We've tried the better process, whereas there is that person who is fighting for us, and we added a 5th party in the mix who they are a specialist in getting money out of the insurance companies and talking to the TPA and talking to the adjuster, and their job was to kind of like corral the troops and help herd the cats and get it along to get the maximum dollars possible. But as you would expect, when it comes to expectation versus reality, those people, those what I called leeches a couple of weeks ago, those leeches basically just didn't help at all. So the process was still extended and still was painful when it came to the whole thing. So
have you guys ever had any permanent depreciation held on you? The reason I ask is I've had a couple claims in commercial construction where that's happened for owners that we have been dealing with, and like 20% of older elevators was held back completely and we actually ended up having to settle in and jump in. But have you ever had them fully hold back depreciation on certain pieces?
we had the depreciation holdback. That was on Citronelle, right, Reggie?
Yeah, that was Centronel, and it kind of transferred along with the sale, but they had depreciated some part of the asset.
Yeah, so we've had that happen with one of our claims where, and that was a surprise to us. That was not an expectation whatsoever, to where the insurance company forced depreciation basically on the property. I'm trying to remember the specifics of that scenario. Josh, you remember anything else specifically with that depreciation that they forced on us, or the holdback, I should say? What did you get the details?
All I remember is it was like 40 grand or something they were saying, and it was all due to the insurance claim.
Yeah, I'll have to get some. What we wanted to do today, in full disclosure, I wanted to get one of our insurance brokers to jump on here, but they were not able to make it last minute. So to answer questions like that, we can though. If you guys have any specific insurance questions, let us know. We're happy to pass them to our insurance broker, and we'll try to pull those things. There's little nuances like that that Alan had brought up. Is like you may not expect it, understanding like how insurance might affect your depreciation, but there's these nuances that they will affect you sometimes. The other question I saw pop up, yeah, Matt, you brought up the good point of they will do anything and everything to avoid paying. That is absolutely right. They will continue to push, and so they'll give you a little bit of time, right? They'll throw you a little nugget here, a little nugget here, but you're waiting for the big payday sometimes, and that big payday sometimes just doesn't come because it's in the form of they're slowly bleeding you out. And then Deepak brought up the question of, are there possibilities for insurance takeover where effectively the buyer takes over the current insurance policy? And the answer is yes. That is something that does happen. I don't want to say frequently, but it does happen. In the case of one of our earlier purchases, we did that. We effectively took over an active claim that was happening, and so we took over the policy that was in place. Now, it's going to be depending on how the policy is written and what goes on with the specific policy. But to the short answer, Deepak, to your question is yes, you can.
Yeah, and that can also be a negotiating tactic too.
Yeah.
Like if the buyer has a lot of multifamily, they may have a great loss limit policy that gets them a 20% discount against
what you might find in the market. So you can say, hey, yeah, Mr. Seller, I'll pay your purchase price if you agree to keep me on the policy.
Yep. Now, the last point here is going to be reviewing policies annually, which is going to be a requirement as they come due when you look at these new policies. But one thing to consider is just, continue to shop around, continue to be smart. Insurance is almost a low-hanging fruit when it comes to your NOI impact. Now, realize your biggest impact on your NOI, well, your biggest impact when it comes to cash flow is going to be your debt. Right, your debt servicing is going to typically be your biggest impact when it comes to cash flow. But taxes and insurance are two things that people don't talk about enough when it comes to trying to boost your NOI. Reggie is part of our group that he does a fantastic job of refuting taxes. So every year, I love when Reggie goes in there, just ball into the property appraiser's office, being like, "Hey guys, our property sucks. We got this going wrong. We got this going wrong. We got this going wrong. Our property's not nearly worth this. Look at this. There was a murder in our property last week. No, it's not worth this much. Come on, guys." And so we fight to show the lowest value possible when it comes to taxes. And that's one very, I don't want to say easy, but it's a low-hanging fruit that people don't typically go to when you're thinking about, oh, how can we boost NOI? They think of like, oh, what about saving water here or doing this, or how can we boost the rents? But realize taxes and insurance is another thing that I want you to consider and really emphasize on ways you guys can really bolster NOI, or you can really shoot yourself in the foot, right? You can really hurt yourself if you're not shopping around it properly, or if you're not being conservative enough when it comes to considering your insurance needs. And so one of the things we're doing personally right now is we are shopping around, like kind of what Reggie was alluding to, is a master insurance policy. So we're reaching out to some bigger operators that we know, or some friends that are syndicators as well. And we're saying, hey guys, what if we all get together and just do one master policy together? What would that look like? And so we're talking to our friendly insurance agent right now, and we're trying to get the details of what that might look like. And that could be a benefit to everyone in this group too, where if we start to get this master policy together, we can all kind of gleam onto one larger policy together. And it should be almost like a bulk discount is effectively what it is when it comes to the master insurance policy. So we'll, if Deepak gets a property over in California, and then we got Brian up in where were you guys? In Carmel was the name of the town. Indiana. Where were you guys again? Up there somewhere. I think Indiana, somewhere in the Midwest.
Yeah, Carmel, Indiana. There
you go, Carmel, Indiana. So we're getting properties all over the United States, and insurance companies love to see that, right? You're mitigating risk. Like the fact that it's very highly unlikely that some Cat 5 hurricane is going to crush Mobile and flow all the way up to Indiana, right? Like that's not a concern when it comes to like catastrophic risk. And so the better we can get these master insurance policies, this is what we're currently actively involved in heavily. That's our goal. And if we do successfully engage in this master policy, this is something that ideally everyone here in this group can benefit from as we grow that policy out. So just something to consider. One more benefit of knowing people and being part of a good group of guys there and gals. All right, so that's it, guys. That's insurance. I know it's a super dry topic. I appreciate some of you trying to engage and ask questions. Well, I promise we'll have more engaging topics in the future, but this is one of those necessary evils. Like I said, this could be one way that you could really make or really crush a deal. One of our deals, like I said, we went from $70,000 a year in insurance to $180,000 a year in insurance. And that is not an insignificant sum when it comes to how it affected NOI and the overall value of our property. But luckily, we were very conservative in our underwriting, and we bought a deal that we bought it at such a deep discount. We were still able to limp along, and we're still living today because we bought the deal at such good terms. So anyways, that's insurance. We talked about basic needs. We talked about property coverage, liability, and the big picture business nuances there, how to start the process, the payment piece of it, and just understanding expectation versus reality is really huge in this mix. Any other questions, guys, when it comes to insurance?
Just one comment on, you do have to stay on top of your brokers during renewal, because they typically get stuck in their own small group of carriers and they don't shop it, especially if you've been with them for a while. You have to push them, or you have to find another broker to compete. And then it gets tricky because you're doing agreements to to keep them from getting to certain carriers, but you do have to push those guys because they get stuck in ruts.
Yeah, I mean, Alan, you bring up a good point. I mean, this is one of those, it's an interesting industry where it's almost like a curtain, right? You're not allowed to go to carriers directly. A lot of carriers won't let you go directly. You have to go through an agent. And so you're beholden upon the agent, but at the same time, you can't shop too many agents, to your point, because then when you start double shopping the same carrier, then you have the drama there. And so it's a really interesting nuance when it comes to insurance. And to your point, it's just staying on top of as much as you can. That's why I wish I had a better answer for you there, but it just comes down to constant communication. All right. Any other questions overall, guys? Yeah, that's exactly right, Michael. They've created their own industry for themselves. That's exactly right.
Monopoly.
Yeah.
Well, some good news, the insurance markets are cyclical and they move in about 10-year cycles. And from the folks that I've talked to, they said we've probably got about another year of pain, but after that, we should have hit that peak and things will be on the way back down. So, hopefully NOI would decompress at least, as a result of some insurance relief over the next couple of years. So, if you're underwriting deals, take that into consideration. I wouldn't necessarily build that into your underwriting, I guess, but if you're trying to look at best case scenarios, let's just say, because our insurance used to cost $400 a door back in 2019, and we got quotes last year for $3,500 a door. All right, that's ridiculous. And that's, again, that's an extreme example, but still, most everything we're seeing today, $1,500 to $2,000 a door on the Gulf Coast. And that's even on some non-coastal properties too, but there's little creative ways that you can still hack insurance. One of the things we did at Chase Park, one of our favorite properties that we talk about a lot, we put fire suppression systems on each stove, $250 a piece. And the ROI ended up being over 50%. So we might have spent about $4,000, and we ended up saving about $8,000 a year just from that one investment. So.
Yep. Good stuff. Anything else, guys? Any questions overall? We still got about 4 or 5 minutes before we close up officially, but any topics outside of real insurance you guys want to discuss, or any good deals you guys are looking at right now?
I have an insurance question.
Yeah, go ahead.
Is there a metric or ratio of insurance over rent or insurance over, asset value that we should be looking at that, would identify, oh, this asset has a really high insurance ratio?
Well, I'm just going based on experience. What I've seen over the past couple of years, used to be the rule of thumb was, insurance was going to be about 5% of your rental income, your stabilized rental income. Now it's more like 15%, so kind of throwing the rule of thumb out the door. But it's really it's fixed. It's a fixed cost to an extent, kind of like property taxes. You always know you're going to have it, but it should flex and grow with your income. And so it might creep up one year, but if it is going up, maybe that's because property values are going up, and if they're going up, then maybe more people are renting. You can see some rent growth, and you kind of grow with it. So you're generating more income as your expenses are going up. So, did that answer your question?
I've not seen a ratio, Michael, personally, that I've been satisfied with. It really comes down to even along the Gulf Coast, or even outside the Gulf Coast. I mean, if you look at a property that's, that's waterfront versus a property that's 2 blocks from the beach versus a property that's 10 miles inland, in similar areas, I've not yet found a ratio that holds true, because the rents don't fluctuate the same as the insurance rates do. It's just not a linear kind of correlation from what I've seen. So I'm sorry. I wish I had a rule of thumb for you to hold through, but for me, what my big takeaway is typically the operating expense ratio. So I'll look at the total expenses, and ideally I'm holding to around 50% or better. for operating expense ratios. Ideally, I don't want to be breaking 55, 60% is way too high when it comes to operating expense ratio for me. And one of the big variables are going to be taxes and insurance in the operating expense ratio.
Okay, thank you.
Yeah.
Price per
else,
door is
guys?
really just what I look at. If you see that the price per door on their insurance is $200 a unit, but you've looked at other properties, you've underwrote other assets, you've gotten other quotes from other brokers in that same area, and it's consistently $800 a unit in the area, I'm like, well, shoot, you're paying not even close.
Yeah.
Or
Or you're
vice
buying
versa.
some mom and pop. Yeah, mom and pop 30 unit. Don't be surprised if you see people who just self-insure too. And so that, don't forget to do that. Throw that in your mix. If you're doing any of our standard analyzers, you'll see insurance on the list of things to consider. But some people who are just doing kind of paper napkin deal analysis, and they just pull what the expenses that the seller is showing you, and they don't have management fees and they don't have insurance fees because they're self-insured, they might be running a 20% operating expense ratio. Like, man, this NOI is great. When you throw in your actual numbers for what you're going to be running with property management, with insurance, and whatever other expenses that you're going to be adding to it, just really don't forget it when you're looking at your pro formas.
Oh, also, guys, if your insurance goes up, then the next year you can use that to justify having your property taxes go down because it's reduced your NOI and effectively decreased your market valuation.
Yeah.
Loopholes.
So that is it for the beginner series for insurance. Next week, we're going to talk about branding and marketing 101 from a beginner's perspective.